G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. Today we're doing things a little bit differently because I've got the gang here. So normally I bring in a guest, but I'm bringing in our three brokers and myself makes it four to do a Q&A session on all things finance. So these are the questions that we're getting consistently from clients. And we thought, why not do a special roundtable with our team, kind of pop the hood on what's going on from a Q&A perspective. So I've got Bernadette, Christy David, I've got Damien Walker and Nate Condy joining me. G'day team, how we doing?
Great. Thanks, Aaron, for having us.
Excited to be here.
Thanks, ACD.
I'm excited. I'm super excited. I'm going to jump straight into it. So what we're going to do is do a bit of a whip around and talk around what you're seeing with your particular clients at the moment. I'm going to zoom out a little bit because there's a couple of articles that have come out in the AFR recently, which I think are very, very pertinent and current as well. And the first one I'm going to touch on is this topic around housing affordability. Every time I jump on YouTube, I'm seeing housing affordability topics, not only in Australia, but you see it in Canada, you see it in the UK, for example, in America. So it's not a problem that's unique to Australia, but what it does signal is that housing affordability has hit the worst that it has in 20 years, according to ANZ. So I'm going to jump around and give me your thoughts, because obviously you guys are talking to your own clients as well. What are you seeing from housing affordability as a sentiment, and what do you think is driving such low levels of affordability? I'm going to throw it to yourself, Bernie.
I think I totally agree with the headlines. We've got record low supply. There's not enough developers building, and we have had record levels of immigration into the country. So high demand, low supply, and that's what's pushing this housing affordability. Coupled along with interest rates stabilising for the last few months, there's some real confidence that's come back into the market, and that's what we're seeing in the activity with our clients.
Cool. Nice one. Thanks, Damien.
Yeah, and I think going towards the point of the unaffordability of housing, I think I'm seeing people who are looking to enter or people who purchased within the last 5 years are probably finding it pretty hard to keep up with their mortgage repayments. That's just on the back of, we had the low rates during COVID, 2%, 3%. Now most owner-occupied rates are sitting at 6%. Investment rates are starting with a 7%. So the higher the interest rate, of course, the higher the repayments. We've also got record high prices. I think we saw 20% growth during COVID. We saw 10% in Sydney last year. These numbers are quite rough, but they do lead to generally where we are sitting with housing growth. So interest rates coupled with high property prices, you're going to get unaffordability.
Yeah. Thanks very much. Nate, what are your thoughts?
Well, we've seen ourselves over the past few years, especially after COVID, the baby mum and dad playing a big part in, I guess, people being able to get into the market. So that's, while their borrowing capacity might not support, say, a 20% or, the 5% deposit with the first home buyer schemes, mum and dad have been chipping in and helping out.
Mate, you're spot on. It's exactly what came up in this article, the AFR, saying the bank of mum and dad last year contributed $2.7 billion into the property market, and that accounts for about 15% of borrowers that got a leg up. It's a real disparity, and we see it time and time again with clients, for example, it's the case of haves and have-nots, and that gap will get wider as that continues to go on. I feel like the biggest part of the sentiment where that really hurts is younger borrowers, and what they were told to do was go study, find a profession, get a job, but what they've walked out with is a ball and chain, which is effectively their HECS debt. And this is one question I want us to shoot through as well, going, how does HECS affect your borrowing capacity? I'm going to look at yourself, Nate, Damien, predominantly working with our younger first-time buyers as well, younger clients as well. When you're doing serviceability calculators and you're factoring a HECS debt, what are you seeing as average HECS debts, one? And then how does that affect borrowing capacity? I'll go to yourself, Damien.
Yeah, really good question. It's a really good point for younger buyers, and more people are getting degrees. So more and more people are coming out with a HECS debt. Help, what's the new STSL? There's a few different acronyms for a student loan. What I'm finding is the younger the person, the higher the debt, of course, but the more recent the graduate, they come out with such high HECS debts now. I think that the average bachelor's degree, you're coming out with 40 to 50 grand. If you're coming out with any type of legal degree or a doctorate, you are looking at your HECS balance in the six figures.
6 years. We did one, I think physio had 120, close to 120. That was obviously post-grad in there as well, but that's wild, right? We are literally going down the path of being in little America with these HECS debts, these student loans, right?
Yeah, it's massive. You think they went to Harvard, but they went to UNSW. And yeah, I'm seeing 150 grand, I'm seeing 200 grand. When people are, especially when you find that someone's hit their career, hit university, they haven't found that spark in that first degree and they go back. And there's nothing wrong with that, but it probably is a broader conversation towards, people going to uni so young. These are big financial decisions that are going to impact you later on in life. But what I am finding is, people are coming out with anywhere between 40 to 100 grand on average. The beauty of the HECS debt when it comes to the bank's calculator is they do not assess based on the loan size. So don't worry if you do have something in the six figures. They're going to be basing your commitment on your income, just like the government will take your repayments. And if you do have a HECS debt that's getting closer to completion, sometimes it's beneficial to pay it off if you want to increase your borrowing power. And we do those calculations. If we pay off your HECS debt, say you've got 20 grand left and you pay it off, but we get a 40 grand uplift in your borrowing, then it does make sense if it's going to get that little extra, a bit more room in your budget to really uplift that asset.
Which is the chicken and the egg scenario, because you're like, I'm losing part of my deposit, but I'm increasing my borrowing capacity, which is the lesser of two evils, for example. And that's obviously a case-by-case basis, but these are just questions to be asking of your broker or as you're going through that initial phase of what are my options as well, right?
Exactly right. And look, the other thing is I'm giving up an interest-free loan to potentially get a higher interest loan. But I think what we've all figured out over the last couple of years is that the HECS isn't exactly interest-free, it's indexed. Yeah. So it will increase in line with inflation. Yes, interest rates are at 6%, but we did have the indexation last year at 7%. Yep. I think this year we'll probably see index at about 3% come May, but we'll know more soon. But yeah, it's not exactly giving up a completely interest-free debt. Yeah, look into it a little bit.
What about yourself, Nate? What are you seeing?
I thought Damien took everything I was going to say. Me, myself, having a HECS debt, this is something I'm considering myself, whether paying it off before purchasing my first investment property. Yeah, definitely. Everything Damien said, we can definitely look at paying off your HECS debt. If you've got a low balance, right, and it's going to increase your borrowing capacity by 100K, right? Mm-hmm. Definitely worth doing it. Especially with the first home buyers, you might be, I guess, taking a chunk out of your deposit. But if you're a first home buyer, you've still got access to schemes depending on, income thresholds and property price thresholds. So, I think definitely speak to your broker and see what they can come up with for you.
Cool. Thanks very much. Yeah, the AFR article kind of did a bit of a breakdown. So 100K income, annual HECS or help repayment of $6,000 reduced the borrowing capacity from 503 to 445, which is a drop in close to 60K. If you're on $150,000 income, this is assuming that you're a single borrower, your borrowing capacity dropped from 735 to about 595, which is just around 140K. So these are not small numbers when we're talking borrowing capacity. That's the difference between a mediocre entry-level property to maybe a decent property at, say, 735. So again, I want to share that question because that comes up time and time again, particularly for our first-time buyers as well. Talking mortgage myths, and this is something, again, that gets kind of, we get this a lot, which is, I'm going to shoot to Damien on this one, probation. So someone started a new job and there's this fallacy that they can't get a loan for 3 months or 6 months until they pass probation. And we just come in and going, I don't know where this silly myth has come from. Absolute rubbish. But you can get a loan on day one of starting a new gig. Take us through, policy. Take us through policy.
Yeah, that's correct. It's quite I don't know where it's come from. Maybe it was something that's been passed on by our grandparents, but it definitely is not the case anymore. If you are on probation, you can still get a loan. There are certain banks that will accept you on day one of your new employment, given you've got an employment contract, and once you've got that first pay slip, they can formally approve your application. That is regardless of your history. So your employment history does not even get taken into account. You could have had a nice break from employment and then come back into the workforce. A bank is still going to accept that income. Now, a large majority of the banks will want to see some type of employment history confirming that, yep, you've got skills and experience in that industry. But still, if you've got that, then banks can accept you on probation. definitely is a mortgage myth, one that we like to bust quite easily. It makes us look quite good. But yeah, definitely a mortgage myth.
And one caveat on that essentially is casual employees. Casual, most banks will want to see, or not most, all of them will want to see at least 6 months history without gap. So what Damien's gone into is more for the part-time and full-time employees, when you generally will have a contract, right?
Yeah.
But yeah, for casual, you will generally need to be 6 months continuous history.
And how can you tell, Nate? So how can I tell if I'm casual or if I'm part-time or full-time? Because that's something some people don't know.
If you get leave entitlements on your payslip or in your contract, yeah, you're part-time or full-time. And if you get no leave, you're casual.
Okay.
Beautiful. Well said. And these are the other questions that we really like asking, because when someone started a new role, we're like, hey, it may open up more lenders, because if you've got less of a 30-day gap between your last role to your new role, banks will consider that. If you've changed same role, same industry to a new employer, they'll consider that. For example, you may have got a bonus in your last role, which won't be counted in moving forward. But if your base has gone up, it may negate that as well. So this isn't a one-size policy fits all, but it's worth, when we ask the questions and time again, for us to make sure that we're turning over every single stone as well. Thank you very much. Bernie, I'm going to throw to you, because you are doing probably the lion's share of work at the moment with self-managed super funds. Why are you seeing such popularity at the moment, and what's the type of inquiries that you're getting for SMSFs?
Thanks, Aaron. Yeah, so it's really driven by people who are itchy to buy property, have been sitting on the sidelines for 12 to 18 months, but have maxed out their borrowing power. So they want to buy, and they're looking for another way to get into the market. So the beauty of SMSF is it's looked at entirely on its own. So the lenders don't take into account your personal liabilities. They look at the SMSF and only need to see the super contributions going in and the rental income from the property that you're purchasing, or the properties that you're purchasing. So I'm speaking to clients anywhere from people who have 120,000 in their super all the way up to 700,000, 800,000 in their super. And we're mapping out a plan for them to talk about how they can get to 1, 2, 3 plus properties in their super. And it's very exciting for those clients who are looking for those opportunities for properties. And I suppose it goes to as well, this is a bit of an extension on just the finance. It's the type of property and your investment strategy in your SMSF. It is slightly different to your individual capacity. So SMSF, I always like to say, it's a longer term play. The asset we want to purchase, because we get depreciation add backs, is a relatively newer asset. It's one that you are going to see high growth prospects in terms of capital growth over the next 10, 20 years because of the tax advantages. There's just so much I can talk about, but we are seeing a big increase in inquiry and people wanting to get pre-approved in their SMSF.
Beautiful. Thank you very much. Yeah, it feels like SMSFs are the flavour of not the month, the flavour of the year at the moment from all the inquiries that we're getting. So thank you very much. I want to throw to you, Damien, because this case study, it even impressed me. And not that I'm hard to impress, but I saw it, I'm like, this just set a whole new standard for us, I think, as a team, where you had a client come to you, they'd had a chat to a previous broker, and then I'll get you to take me through the scenario because I don't want to butcher it. But the way that you went and set about a property game plan, effectively how to scale up a portfolio, was like, this is what we're about, where it's like, hey, you come to us. There's a bit of an X factor when we look at how to structure your loans, then that long-term investment play, and really trying to help people get to that 1% property investors, which is a good quality portfolio, 6 or more. And you've achieved that. So take us through kind of start to finish what you did, a bit about the scenario as well.
Yeah, definitely. This was an interesting one. And obviously just prefacing this is not financial advice, but the client came to me with, he had 2 properties, an owner-occupied property and an investment property, and he was looking to buy his third, and he also said to me, look, I'd like to get the 4th and the 5th. So he had it in mind that he wanted to scale up his portfolio by 2 or 3 properties within the next 12 months. Sitting in his offset account was about $400K in cash. So his owner-occupied loan was pretty much fully offset. He was in a really good cash position. And the broker he did go to advised him, just use your cash for the deposit. Pay cash for the 20% and stamp duty for the investment property, and then we'll just do the loan. again, not financial advice, not accounting advice, but from where we stand, using your cash to buy investment properties isn't normally the correct strategy for an individual. You'd like to be maximizing your debt for your investment portfolio because you want to maximize the amount of deductible interest you get and then maximize those potential negative gearing benefits you can get from your portfolio. So what I suggested instead was first, all right, let's have a look and see how much equity you've got, because you've got a lot of cash. That's great. You could effectively knock off your owner occupied debt if you wanted to. If you want to keep access to it, that's fine. But let's look and see where we can draw equity from your two existing properties, and then use that equity instead of using your cash. Now, what that allows you to do is maximize your lending for the investment properties and try and get as much lending against these properties as possible, but also gives you the flexibility of having that cash sitting there as well. Like, you do not need to use your cash. You've got borrowing capacity to support the equity loan plus 2 or 3 purchases, which we mapped out for him. We ended up getting a $400K equity loan out from his investment property, and then we split that into 20% plus the costs for 3 properties, the stamp duty, buyer's agent, legal fees, and then completed 3 purchases along the line as well. But that allowed him to pretty much borrow 100% plus costs for 3 properties, keep his $400K cash sitting in his offset account, and that just gave him so many more options. Pay off your owner occupied debt if you want to, use that cash for future investments outside of property. Of course, not advice, but here's the things that we are seeing that we can provide to our clients, that when you go to maybe a broker who isn't as investment savvy, they're not going to be coming up with these ideas for you. And you potentially getting yourself in a position where you bought the property without the foresight of the next one or the one after, and then you get caught.
And that, and you just think, well, he pulls a 400 cash out. Now he's paying back a home loan that he doesn't necessarily need to. Like, where, again, which is, there was one thing after another. I'm like, this is, we never take pot shots because we love our broker community, but you're like, this is really bad advice, and I'm really glad you've come here because we can put you in the right direction. And that could have been a potential mistake. And once these are done, they're very hard to undo. You're past the point of no return to make some of these decisions right again. So expensive. You avoided an expensive mistake for an investor. Now it's like just the amount of the compounding effect of those 3 properties that are increasing in value. He's got owner occ plus 4 investment properties that are now compounding. There's equity to go again. So again, we're not relying on cash.
And one thing that we do find, you can't create investment debt. So once you pay cash for a property, it's done. It's gone. It's now parked in that property. The ATO doesn't allow you to draw it out unless you're using it for that property again. So you need to be very careful that when you are buying an investment property, if you're using cash, one, that's the best option. So speak to your accountant. But really, if you got equity, you should be utilizing it.
And just speaks to one of our golden rules, which is always in investing, is about paying down your non-deductible debt, your PPOR debt, your owner-occupied debt. Let's pay that off first as a priority, isn't it? How do we make that a goal along with investing in future properties?
Correct. I mean, that comes to loan strategy, because so many times people are like, oh, I should go P&I in the home and P&I in the investment properties. Like, I get it. I know what you're trying to do here, which is pay off your investment property loan. But you're like, why don't you just channel as much as you can, extra payments, park all the cash into the offset account for the home loan, chip away at that bad boy as much as you can before tackling the investment property as well, and trying to pay P&I on that. So again, we'll talk to what stage someone's at, whether in that heavy acquisition stage, whether in a consolidation phase, or that pay down stage in life. So again, it's not a one size fits all model, but what we're saying is we need to zoom out and go, what are we doing and why are we doing it? Yeah. Cool. Thanks very much. I'm going to change tack a little bit and talk about one of the recent reports that have come out. So on one of our previous episodes, we've had Craig James from Commsec appear. So if you don't know Craig, he's one of the leading economists there at Commsec. And every month they produce the State of the States report. Now, you guys haven't seen this. So I'm going to put you on the spot here. And they go around the states and they rank state performance and they see who's the leading state. So Bernie, who do you think is the state that's leading the nation at the moment?
In terms of property growth, capital growth?
They're taking it across indicators like, what do they got? Equipment spending, housing finance, population growth as well, retail spending.
This is hard. I'd be saying I've got 3.
You can choose one.
3 out of 7. Come on.
All right, I'm going to say Queensland.
Look, I think that always and forever New South Wales is a financial powerhouse of this country. So I'm going to say the cockroaches.
He bleeds blue this week. Mate?
I'm with Bernie. I reckon Queensland.
Wow. Well, you guys are wrong. Queensland came in equal fourth along with New South Wales. Yeah. Who wants to have a guess? Number one.
WA.
WA?
Yeah.
Wrong. SA. SA is ranked first on 4 indicators. And if you're listening to this, I'm going to include the link to the State of the State reports because this has got some really good data in here.
Yeah.
So they're coming in flying colours. The second is WA for relative population growth. Third is Victoria, which surprises me.
Yeah.
Their weakness there is housing finance, and we see that. We see a weaker market there at the moment. Equal fourth is actually Queensland, New South Wales, ACT. Yeah. ACT's strength is retail spending. New South Wales is economic growth, and Queensland is housing finance. They're in the way. And Tassie also equal fourth here as well, equipment spending. So there's a mid-pack, and then you've got rounding out the last state is NT, which, that's not surprising at the moment. So a bit of useful data there. So again, if you're keeping an eye on what's going on nationally, that's a very, very good piece of research there as well. I want to finish on one of the other articles that came out, which is they dubbed it mortgage prison. Now, I've heard this term in mortgage broker land. We've heard this quite a number of times, and this is where someone is unable to refinance their loan. Now, mortgage prisons could happen for a few reasons. Now, let's say, for example, Bernie and I were married, and then we had our second baby, and Bernie couldn't return to work, so we couldn't refinance. So effectively, a mortgage prisoners because our situation has changed, or I've become recently self-employed and I can't switch banks. But I've got to be grateful for the loans I've currently got. The other reason that people can't switch is because of valuations. So they've gone back to their existing bank and they said, look, the property value hasn't increased as much, therefore you can't refinance, or you can't refinance to another lender, for example, and you're stuck where you are. And that means, for an investor, if you're listening, that means two things. One, you can't buy more investment properties because you can't switch out. And second, you can't pull any equity out. And that tends to what we call the frustrated investor. The case study I've got to share is the power of multiple valuations. I had a client that was over in Adelaide, and they were talking about, they've done some work on the property. There weren't too many recent comparable sales. And I'm like, look, they think it was around 650. I said, I think actually we can go more. I looked through the sold tab, I looked through what's going on recently in the area as well. I said, I reckon we're up to about 720, 730. And we did a series of computer-based valuations that sat closer to that sub 700 mark. But we sent a full valuer out there to do a full valuation. 2 valuations came back, one 730, one 750. So it really highlighted to me, like sometimes we always lean on computer valuations. Other times we go full vows. I'm like, this is where you need that little bit of persistence to go, right, we know how to read valuations. We get a gauge because we can run it a number of times to really push it up. And that's the power of valuations. You run it multiple times. And if you want to pull out equity, rate becomes irrelevant, isn't it? I see that everyone's on in their head. I'm going to throw to yourself, Bernie. What are your thoughts when you've got clients? You're like, hey, man, let's cast the net out wide when it comes to valuations, because we might get extra equity here. That means, you got the ability to go again.
I've got another great example if I wanted to share ACD. It's a client who we're trying to release equity in their own occupied home, currently bank with one lender. And that bank went out, did a valuation, 880 for the valuation, and the client was insisting the property was worth 1.3, 1.4. I couldn't understand.
That's a massive difference.
That's massive, right? We did another valuation with Bank 2. Valuation came in at 1 mil. Again, clients like, this is not right. I could easily sell this in this market for 1.4.
Which is the question that I could easily sell it, because are we based on a real estate valuation or market appraisal, or are we based on what a valuer appraises the property?
Exactly.
Right?
And then the final valuation where we landed for this client with Bank 3, 1.3.
Wow.
It's a difference of $420,000.
And it just goes to show that valuations are not a science.
It's a dark art.
It's a dark art. It's a purely subjective experience. And, I always think sometimes they just miss their coffee in the morning. You will naturally have conservative people, and sometimes you had that conservative valuer who looks at the 800K price. And I struggle to understand why that is the case. But from what I can gather is sometimes they look back, they don't look forward, especially when a market is changing really fast. I mean, we've seen, I think the stats out of Brisbane now is is it 50% in the last 2 or 3 years, or 50% growth in? It's definitely under 5 years.
Yeah.
So we've seen a massive growth in, say, the Brisbane area, and sometimes the valuers aren't willing to accept it just yet, especially when we're starting to push up 10% every year, 5% every 6 months. The value is still looking back, and they're looking at sales data from 3, 4, 5 months ago, instead of looking at what's on the market for sale or what's close to settling around the date of the valuation.
Yeah. I mean, I've had chat with valuers, and they won't take until it's settled. They won't even factor it in, and then when stuff's going off market, for example, we know that other clients are buying there. It's like, hey, we know what the current selling performance is like. Not until it's sold and banked and settled in the system, they're not going to factor it in. So this is, if you're listening and you know of recent sales in your area, and you're like, I think I can rely on that. Until it's settled, a valuer is not going to factor that in. Cool. That's So I'll circle back around that one and say, look, the power of multiple valuations. Speak to your broker and go, look, how many vals have you done? And it costs you nothing as a broker and as a borrower. Valuations, predominantly, if you're not going to a non-bank lender, do not cost you a cent, right? So there's nothing ventured, nothing gained. I say this to my team. I'm like, that's effectively how I really earned my stripes as a broker when I started out. Was like, I just did so many valuations and just said, look, I'm going to find and scrape equity out. And clients really appreciated that level of like sweat equity at the start to try and get more cash out, so you can go buy more property, more equity out, more properties you can buy, or better quality assets. That's what we're all about here as well. The last point, which I wanted to bring up, and this might get this little vein going on the top of my forehead, for example, which is credit cards, the bane of our existence. We can't understand it. So someone can correct me here as to why people want to hold onto credit cards instead of get better borrowing capacity. I want to be a student. I want to learn, but I'm missing something here, because every time we tell people to cut credit cards, lower limits, it's like, no, I don't want to. We're like, this reduces your borrowing capacity. So take me through, Damien. And Nate as well, you guys are the numbers gurus. What's the impact of a credit card on borrowing capacity?
Yeah, so I'll jump in here. So generally we'll see with the bank's calculations, for every $1,000 of limit you have, it'll affect your borrowing capacity by about 5 to 6K. So if you've got a 5K credit card, 25 to 30K of your borrowing capacity will be wiped just from that. Even if, clients will come and say to us, I pay it off every month. The bank doesn't care, because at any point...
You can max it tomorrow.
Exactly. Yeah. So... 5 to 6K per $1,000.
And we have people that come to us with, like, they're not coming to us with 5K credit card limits. It's like $15,000, $20,000, right?
So if someone's got 2 credit cards, $20,000 each, how much is that reducing their borrowing capacity? And they're holding on to it for the points. I understand points are important. I collect them too.
Points, schmoints.
Yeah, that's it. So if my math is correct, 40K of limits, that's 200 to 240K.
That's crazy.
Which is outrageous. And the thing is, like, as soon as you settle the loan, the bank you settle with is going to try and set you up with credit cards anyway.
Correct.
So if you can close them off, it's only going to benefit you.
We're trying to, and this is it. It's like, hey, sometimes they don't need to because they've got the borrowing capacity strong enough, or their purchase price is less than what they need. But when we're trying to really push that borrowing capacity to, scrape the barrel and crank these numbers up, it's like, hey, mate, is this credit card, can we lower it? I don't want to. And like, dude, what's more important here? And I think that's where, Damien, you really kind of go, what's the priority? Is the credit card the priority, or is the property the priority?
Yeah, definitely. And look, I sort of understand the pushback. You've set up the credit card, you've set up your direct debits coming from it. You've got about 7, 8, 9 providers you need to call to change it. I understand it to a certain extent, but when we're talking about it becoming an issue for you to buy a better property, you need to suck it up. It's a bit of life admin. You get it done within the hour. It's just something you need to just move on with. If you know you're going to be borrowing, just cut them up. Maximize your capacity. Yeah, it's the best way of doing it. And if you want a credit card, there's nothing wrong with credit cards. Have them in place. If you want one for your direct debits, I'm thinking out loud because I've got one with points at the moment, and I'm thinking when I have to go and close it, I'm like, oh God, there's a few bills coming out. Set up maybe like a low fee credit card with a really small limit. Have your bills come out of that one, and then go and chase your points, because I get the points. That's where the 15K credit cards come in. That's when you need the higher limit to get the points. I get it. You get your frequent flyer, you get your upgrade. good on you, but don't let that be the thing that stops you from borrowing more and buying a better property. Suck it up, cut it, change your direct debits.
I'm looking at Bernie, I don't think any of our household runs through a credit card, does it?
No, it doesn't. I've got a passion project called Buckets. Buckets, not budgets.
Yes.
So we've recently changed the way that we manage our finances, and budgets, I find, just didn't work. They were too stagnant. And I've introduced this bucket system. And since we've done that, it's taken out so much head space. Our bills run smoothly, and it's all without credit cards. Yeah, I know we're forgoing points, but that peace of mind, knowing that we know where the money's coming from for every single bit of our financial budget, it's given us some real peace of mind.
Yeah, I think the over-reliance on credit cards is, I'm spending it, I'll pay it back. But it becomes like if I'm running our business through credit cards and just like, I don't know, it's just borrowed money, and I'm ticking time bomb for 55 days interest-free periods. I'm like, man, if I got the money now, I spend it. If I don't have the money, I'm not going to spend it. I feel like that's the crutch that credit cards provides. Going, I'll find the cash in the future. That just comes out of future spending or future saving. I don't know. That I feel like we'll do a deeper dive into credit cards as our nemesis at some point. But yeah, I feel like that just might whet your appetite there. Just go look, if we're suggesting that as a solution, alternative, recommendation to lower or kill off credit cards, we're not doing it on a whim or being flippant. What we're saying is we're trying to improve borrowing capacity so you can buy a superior quality income producing asset. That's the message that we're really trying to hit home. And it's been a slightly different topic that we've covered off, but I feel like, people are asking to hear from our team, which I really, really appreciate. All the listeners kind of dropping some mad feedback as well. So if you've loved this episode, drop us a question that you want answered for future episodes too. We've really enjoyed it. We'll talk to you soon. Thanks very much.
Thanks.
Thank you.